fund manager, gold and silver are set up to soar. Dave Kranzler explains the likely driver of the next move higher in gold, a move higher that will be reinforced by this huge fundamental factor. By Dave Kranzler of Investment Research Dynamics per the latest COT report. Note, this references the August 21 COT report. The hedge fund, managed money, net short position in COMEX paper gold was 90,000 contracts, by far a record short position for the hedge fund trader category. Conversely, the bank net long position, swap dealers, in COMEX paper gold was close to an all-time high. It's not quite as high it was in December 2015. The hedge fund long position in US dollar futures is also at an extreme right now, with the banks taking the other side. Unless there's something devious going on behind the scenes in the reporting of this data, possible but not probable, the banks are positioned for a huge move higher in gold and a sell-off in the dollar. The only question is timing. The commercial category of the COT report, banks and producers/merchants/processors/users, is net long silver futures for the first time in at least 25 years. In combination with the gold COT report structure, this is the most bullish setup for the precious metals in history. Note, per the latest COT report, positions as of August 28, the hedge funds reduced their net short by 16,000 contracts and the banks reduced their net long by 2,700 contracts. The hedge fund covering explains why the price of gold rose roughly $20 between August 21 and August 28. The chart below illustrates the extreme positioning by speculators in gold, interest rates, and the stock market. The graphic shows the net short position of non-commercials, managed money, other institutional pools of investment money and retail traders, in gold futures, 10IR Treasury futures and VIX futures. It's the largest bet in history by speculators that gold and 10IR Treasury bonds will go a lot lower and the stock market will go a lot higher. Volatility declines as stocks rise, so a short VIX bet is a bet stocks go higher. When positioned at an extreme like this, speculators are always wrong. It may not seem like it right now, but I would also suggest some type of development is percolating that will trigger an unexpected and substantial sell-off in the dollar. Based on looking at the increase in the hedge fund net short position in the gold futures COT report between the end of June and the latest report as of August 21, it would appear as if most hedge fund short interest contracts were sold short between July 31 and August 21. During that stretch, the price of gold dropped from $1,224 to $1,170. I'm guesstimating that the average price on the hedge fund net short position is between $1,215 to $1,220. The is a rough estimate, but I would bet it's pretty close. This is important because it tells us the price level at which we might see a big short cover move higher begin. Last Friday gold shot up from $1,194 to $1,212. From this past Monday, August 27, through Tuesday just before the COMEX floor opened, gold ran up close to $1,221. About an hour into the COMEX floor hours, gold fell off a cliff quickly down to $1,207. This price hit occurred in the absence of any news or events that would have triggered a sell-off. In fact, the yuan rose sharply vs the dollar on Tuesday, which throws cold water on the theory that the Chinese have pinned gold to the yuan. The point here is that the hedge funds will be motivated to defend the $1,220 price level. Above that price, the hedge funds will start to lose a lot of money on their net short position. This is the only way I can explain the waterfall hit on the price of gold on Tuesday. If the price of gold can climb over $1,220 toward $1,230, it will likely trigger a short cover move. But keep in mind that, as the price momentum heads higher, the hedge fund position will swing from net short to net long. This is likely what will the drive start of the next move higher in gold. A move that will be reinforced by the start of the big seasonal buying season in India and China. Based on the numbers I see on a daily basis, the Indians and the Chinese are taking advantage of the lower price of gold and have already ramped up their gold buying. When the Fed is forced by the economy to fold on rate hikes, gold will really begin move. The junior mining stocks are trading at one of the lowest valuation levels over the last 18 years in relation to the price of gold. U.S. Gold Corp., USAU, traded briefly below $1 last week in the absence of any news or events that might have affected the stock price. The market cap is close to 50% below the intrinsic value of its Copper King project. The stock jumped 14% on Friday, and Mining Stock Journal subscribers had an opportunity to buy shares ahead of this move. COMEX Silver to test 2015 lows. Craig Hemke. The distortions already inherent to the fraudulent COMEX/LBMA pricing scheme could worsen to levels which would, by Craig Hemke via Sprott Money News September 04, 2018. For nearly 3 years, we've contended that the price lows of December 2015 constituted a bear market low for COMEX digital silver. It now appears that this notion is about to be severely tested. Let's begin, as we often do, by asking you to go back and review something written a few weeks or months earlier. In this case, please check this link from late July, https://www.sprottmoney.com/blog/potential impacts. And now let's cut to the chase. When the prices of COMEX gold and silver bottomed in late 2015, we thought at the time that this was due to price finding a physical floor. Simply put, the price of the digital COMEX derivative was constrained by the reality of sourcing and delivering actual, physical metal at a price below the average cost of production. As such, the price of COMEX gold traded all the way down to $1,050, with COMEX silver reaching $13.60 before a sharp rally developed in the first half of 2016, rallies that led to a 30% jump in COMEX gold and a 50% spike in COMEX silver. And now here in September of 2018, prices are nearing these levels again, and many analysts are projecting that the same metrics which led to a bottom and bounce in 2015 will hold in 2018. Let's hope they're correct. However, as we've been reporting since June, there is one key difference between 2015 and 2018 that many are overlooking. The apparent yuan gold peg. If, and this is a big if, the PBOC and/or the BIS are indeed managing the dollar price of gold, silver and other commodities to match the relative value of the yuan versus the US dollar, then traditional metrics need to be thrown out the window. For example, the AISC, all-in sustaining cost, for many major metals producers has only risen since 2015, as energy costs have risen, too. If the AISC was $14 for silver in 2015, when crude was $35 barrel, what are the AISC in 2018, with crude at $70? And to that end, if the PBOC is in fact taking steps to devalue precious metal against the dollar at the same rate they devalue the yuan, do you really think they give a rat's behind about the AISC of Barrick or Gold Corp? By any traditional measure, the latest commitment of traders' reports are unabashedly bullish. Speculators are net short and commercials are net long. This rarely seen dynamic would seem to be a surefire bullish signal. However, if these extremes are only due to the aforementioned management of the peg, then why would we expect a sudden trend change and reversal based solely upon traditional COD analysis? And consider this, too. In 2015, the global equity markets nearly collapsed after a 25% spike in the dollar index forced emerging market currency chaos. This then spread as a contagion, and the S&P fell 12% in less than 6 days in August of that year. Though the equity markets soon magically recovered, the COMEX precious metal markets didn't bottom and recover until December. Putting this all together, we must once again warn precious metal investors and traders to avoid catching the falling knife. Though it may appear that price is near a physical floor, and though it may appear that the COT positioning is near historic levels, and though it may appear that the charts look oversold, none of this will matter if the emerging markets continue to melt down and China continues its regime of devaluations against the US dollar. In this scenario, COMEX precious metal prices will continue lower, despite all traditional metrics. Thus for now, keep an eye on these two charts. For COMEX gold, the key appears to once again be $1,180. This has been a significant price level on many occasions since a low was found there in late June of 2013. Any break below on a weekly closing basis would indicate that a test of the December 2016 lows near $1,140 was pending, and below there, the 2015 lows await. And as mentioned above, the price break at $14.50 almost guarantees an imminent test of the December 2015 lows in COMEX silver. The key level to watch will be $13.63. Any weekly close below that level would be extraordinarily bearish, and it would place the next downside target somewhere near $12. But let's conclude with a thought experiment that may allow us to close this dismal post on a more positive note. Given that AISC have only risen since 2015, and given that major miners are already suffering and posting losses at $1,300 gold, how many mining companies might be forced out of business at $1,000 gold and $10 silver? Not only that, how would the resultant, significant drop in physical supply affect the physical market? And if the physical market tightens past the levels of late 2015 and gets significantly worse, what will be the impact on the LBMA? And so you see, this is where it could all get very interesting. If China is intent upon driving commodity prices as low as required by the falling yuan, the distortions already inherent to the fraudulent COMEX/LBMA pricing scheme could worsen to levels which would make the system crack and crumble. And this is what we've all been waiting for. How many times have we written about the day when delivery failures take down the COMEX and LBMA? How many times have we spoken of the unsustainability of the current pricing scheme and the game of musical chairs of alleged physical ownership, where there are more than 100 claims on every available, physical ounce? Well, what would a paper price of $1,000 do to the banks, who would be on the hook to physically deliver gold at that price, at a time when the vaults are empty, unallocated accounts are unfunded and mine supply is dwindling? And there you go. Finally, what we've all been waiting for. Total destruction of the New York/London digital gold pool. And maybe this is all part of the master Chinese plan after all? Accumulate physical gold and then force a global reset in price that revalues your gold reserves, which you finally reveal to be 10x what you've stated in the past, multiple times higher. This also revalues your existing mountain of debt. It revives your currency by making it stronger, and it allows you to ultimately offer some sort of reserve currency option against the US dollar. Maybe that is where all of this is eventually headed? We'll have to wait and see, I guess. In the meantime, however, please understand that regardless of traditional metrics, the price situation will likely get worse before it gets better.